Welcome to the Holistic Accountant Podcast. The aim of this podcast is to demonstrate how accountants must employ a holistic approach to help their clients maximise wealth. It's not just about preparing tax returns. So each week, Mena Abraham and I will discuss topics to help you better understand some of the things your holistic accountant can help you with. Okay, today Mena and I would like to talk about stock and managing stock on hand. Of course, this is for people that are in a business that have physical stock. If you're in a service business, obviously it's less important. But Mena, I know that you've got ownership in a business that has a substantial amount of stock. So maybe I'll hand it over to you and pose the question, how do you go about managing it?
Yeah, so basically we manage it by you need to receipt every cost of good or every stock item that you receive each week or each delivery. It needs to be input into your point of sale system or additional sort of application that you use to manage your overall stock levels. So it doesn't necessarily need to be your point of sale system. There's various applications that feed into Xero, for example, that will help you sort of manage your stock. So by receiving or recognizing or recording, I should say, every single stock item that comes into your business, you've got a clear record of how much you've bought that particular item for, when it was received, as well as the cost of it.
Yep.
So, and then basically what you should do is periodically go through your store, through your business, through whatever you're operating on a whether it be a monthly or quarterly basis, and do a stock take. Do a stock take to basically see, okay, what stock is actually sold well, what's moving well, what's sitting on your shelf or in your manufacturing factory or whatever it is, what's sitting on the shelves for so long that you need to move on. So this is a really important key. Otherwise, you could end up with a whole lot of what we call dead stock, or dead money, really,
Yep.
because it's just money sitting on your shelf, things that you can't move, and it just, it's capital that's unused. Obviously, your point of sale system will also feed into your stock management system in terms of telling you, what was sold and at what price and so forth. And then any variation between, your stock take and your point of sale numbers and, you receiving the stock, it comes down to either wastage of stock or theft of stock. So it's really important to know these things. Otherwise, you could, I hate to say it, but, theft can occur from staff or from, external third parties. So it's really important that you get a grasp of these things.
And of course, we can write off that stock, that stock that's lost and get a tax deduction for it. So getting that in the period in which it's occurred from a tax planning perspective is important too.
Definitely.
But what about stock turnover? As a ratio, maybe you could talk about that or explain that.
Yeah, definitely. So stock turnover helps you sort of understand what is actually moving in your business, what you're actually using the most of. Also helps you classify what kind of categories you should be implementing in your business as well. So, for example, if you've got a retail business, for example, that sells liquor, and there's a particular liquor category that's working really, really well for your business, you might introduce more lines of that particular category. It could be wine, for example, or red wine, for example. You might introduce different types of, or different additional category, additional line items of, red wine, because it's actually moving really well. And you might actually be able to improve your margin on those particular items, because if you only improve your margin on your business by just 1%, it has a drastic effect on your bottom line.
Yeah, sure. So it's all data dependent though, isn't it? And that's why stock management is so important. If we don't have the data and the reliable and timely data to feed into the system, then we don't really have very good actionable data. And ultimately that is your business. Stock is your business. So what you do want to do is don't tie too much money up in stock. And if we can get that stock turnover ratio high, it means that we've got a good velocity of cash flow through our business, and that's a really healthy business. Whereas if I've got to go and spend a whole bunch of money on stock, but it's going to take me 2 years to sell that stock, I've got a lot of capital tied up in my business. To grow a business that requires a lot of capital obviously requires a lot of capital, right? So, and capital isn't endless for most of us, unless you're a billionaire, of course. But so a business that is got a really high stock turnover ratio will be able to grow much faster than one that doesn't. And so quite often we see stock take. How often would you recommend you do a stock take, Mena?
I will base it on the volume of transactions in the business rather than so if you're a high volume business and you've got a lot of moving parts, I'll do it probably monthly at a minimum, just to be, otherwise you could easily lose control of what's coming in the door and what's going out, and and have a lot of that sort of dead stock that I referred to before.
Yeah, so some people just only do a stock take every year, thinking, well, I'm going to do my tax return, so I want to write off whatever dead stock or lost stock that I've got. Whereas we would argue that instead of seeing a stock take as something that's something you need to do at year end for your accountant, it's really just part of good business management and good business process. And then once you've got in the habit of really good stock management practices, then it's really about the system that you plug into your accounting system, that your POS system, your stock control system, and making sure it spits out the right information. So that looking at stock by category and so forth, where you can make those decisions that Mena spoke about.
Yep. And then the other question is around funding of stock. So, we generally try to buy stock without, or receive stock without actually paying for it on the day of receipt. So what that does is it helps you with cash flow. So for example, if you get a delivery today, if you've got a month's terms or 30 days terms, you've got 30 days to essentially move that stock on before actually having to pay your supplier. So this is it's incredibly important for cash flow management. But obviously still be wary that you're banking those dollars and putting that money aside to pay those suppliers.
Yeah, so what we're trying to do there is reduce working capital requirements. And if you reduce your working capital requirements, it means then you can decide what to do with that profit each month. Whereas if you've got to reinvest profit back into your business, that's fine if you're growing it and you're getting rewarded from a profitability perspective. But the whole aim really is to have a business that's throwing off free cash flow so that you can either use that to improve your standard of living, or hopefully both, standard of living, and also invest some of those monies. So if you have a business with a lot of stock in it, it's really important that you speak to your holistic accountant and make sure you've got the right practices in place, make sure you've got the right information systems in place, and that will really empower you to run a highly profitable business that's cash flow positive. Okay, that's it for this week. Until next week, bye for now.